Hello folks, Steve Lentz here with Discover Options at OptionView. Welcome to this edition of the Market Reports. This is for advanced options traders, particularly those that trade butterflies and condors. We have two reports for you. The S&P 500 Condor Butterfly Timing Report and the S&P 500 Directional Likelihood Report. This is for Friday, March 31st, getting ready for Monday, April 3rd. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Go ahead and click on the subscribe button and we'd love to get you alerts whenever we come out with new recordings. And then also we have a free ebook here that you can click the link and then give us your information and we'll get that to you as well. So let's go right to it. Here is the current market condition. Friday was an inside bar. That's the price action we're keying on. In terms of the trend, we're above the 50-day simple moving average, and in the stochastics, we are trending upward between 30 and 80. Pretty broad range, but when you combine all this together, there's only been 42 or so incidences of an inside bar occurring in these conditions going back to Jan of 2000. Okay, it's a fairly rare occurrence, and so the distribution of price afterwards is of great concern, as is the likelihood that condor and butterfly traders are going to do okay in this. And so let's go straight to those reports, give you the results, and for those of you that are new and want to really learn about the methodology behind these things, then go ahead and stick around and we'll walk you through that. So let's go to the Condor Butterfly Timing Report. So since Jan of 2000, there have been almost 43, well, there's been a little over 4,300 daily closes of the SPX, all right? Now, of those 4,300, 64.8% have been favorable for selling premium, meaning that the actual 21 bar movement was less than the SIBO skew adjusted implied movement. Okay, so and that's coming from a skew adjusted VIX. So again, almost 2/3 of the bars back to Jan of 2000 have been favorable for selling premium through butters and condors. Now, during that time, our current condition has occurred roughly 42 times. Of those 42 times, 73.8% of the bars have been similarly favorable for selling premium. That means we have an edge of roughly plus 9%. So statistically, it's more likely than usual, by an extra 9%, that Friday's bar will end up having been a favorable one for market neutral option premium selling. Okay, so as a Friday, we have an edge going into here. We have an edge in terms of a condor butterfly, looking at that pattern and how well it's performed in the past. A higher percentage of those have been favorable than the baseline of 64.8%. Okay, so that's it for the butterfly timing report. Let's go to the statistical, looking at the market likelihood report, which is more statistically based. Here we're taking volatility bands to determine price distribution as after our current market condition, our inside bar under these conditions. And what we do is we set up 3 upside volatility bands and 3 downside volatility bands, and these are set 5, 10, and 15 days apart. All right, and so the upper bands are listed in green, and the benchmark, those bands typically get hit roughly between 23 and 29% of the time, 5, 10, and 15 days in the future. Okay, the lower 5, 10, and 15 day distribution bands get hit roughly 29 to 32% of the time. Now, now that's the baseline. That's taking all 4,300 of the occurrences, of the closes, all 4,300 closes. This is the distribution of price in terms of hitting these 5, 10, and 15 day distribution, volatility bands. Now, after our current condition occurs, of those Well, this includes consecutive occurrences, 45. Of those 45 occurrences, all right, the upper bands typically get hit less often than baseline, as you can see, and the lower bands are getting hit more often than baseline, by between 10 and 18% more. And so this is a picture of a bearish bias. This is a picture of a bearish bias. Now, 45 is not that many. We'd like to see 100, between over 100, ideally 200 occurrences, but this is a rare occurrence, and so keep that in mind. But still, we have a bearish bias where the lower distribution bands are getting hit more often than the baseline, and the upside distribution bands are typically getting hit less often. All right, now we can redraw these distribution bands using a skew adjusted VIX. And when we do this, similarly, we have the lower bands getting hit more often than baseline, and the upper bands getting hit less often. So this is a bearish bias. Just want to report that. If you're thinking of doing a bull put spread, going into this, well, you may want to hold off on that a little bit. At least the statistics are showing that, right now there's a bias that's over and above the baseline, leaning on the bearish side of things. So that's it for those two reports. I'm going to dive into the methodology now for those of you new that want to really dive in. And this is the same presentation we do every week, which is fine. And we want to bring everyone new up to speed. But for you veterans, that's the report. I think you get the picture. Okay, went through that. Let's talk about that butterfly timing report. Okay, well, we're just trying to determine if this is a good environment or not for doing butterflies and condors. Why should you pay attention to the report? Well, sometimes you can have the market channeling along, and you might just discretionarily say, you know what? The market's channeling along pretty good. I'm just going to put on a butterfly and condor. Well, if you had run it through our algorithm for this particular price pattern, it would have reported that there was a negative edge given this particular price pattern at the time, meaning that there was a higher than usual likelihood that the market was going to be more volatile than what was implied by the option prices. And in this case, it ended up crashing down pretty hard, meaning that that edge level, that reported negative edge, turned out to be predictive. It certainly doesn't always happen, but in that case it was. And so it's just showing you where the statistics are in terms of that particular pattern. Here's the question on the table, though. Is our current market condition, the one that I just expressed and showed you, is this a good one for selling premium through butterflies and condors, through range trading? Well, we have a methodology for determining this, and let's go and show you how it is we determine if this is a good environment. I mean, isn't that the question every day? All right, if you're gonna place a butterfly or condor, wouldn't you like to have a statistical format for determining whether you have an edge or not in putting that trade on at that time? So here's how we do this. First, we observe how much the market actually moves from a given close. We call that actual volatility. Next, we observe what market move is predicted by the option prices, and we call that implied volatility. Then we compare the two in hindsight, and we'll go back and label bars favorable or unfavorable once we know how much the market moved from that bar compared to how much of a move was implied by the options at that time. So here's how we do, we're looking at actual volatility. We can take any close and we move 21 days in the future and ask ourselves, how far did the market move, up or down? What was the farthest level that it moved away from that close? And in this case, it moved down about 50 points, which turns out to have been 2.4%, which we can graph there in an indicator within my Metastock program. Okay, so what market moved? Here's the other question. What market moved at that time was being implied by the option prices? We know it actually moved 2.4, but you know what? When we go and look at the VIX and we adjust it for the skew, it was actually implying a move of 4.4%. This turned out to have been a very favorable day for selling premium neutrally. The volatility implied by the option prices was much higher than what actually occurred. And so we label that bar blue or favorable, and all the bars then that were favorable we give a blue color. Those that had a huge move afterwards, far greater than what was being implied, we label red. So we have red is unfavorable, blue is favorable. And when we go back in time, okay, this is what we have to do. Our methodology here is we're going to go back in time and determine a baseline benchmark percentage of how many bars in this SPX market were favorable. Then we're going to take the bars that match our current market condition, all 42 of them, go back and we're going to see what percentage of those were favorable. And if there's a big difference, well, we can have an edge there. So when we go back in time to Jan of 2000, we discover that 64.8% of the bars were painted blue, meaning that the volatility implied by the options turned out to have been higher than what actually came to pass. Okay, so that's our benchmark. Now when we go and look at all the bars that match our current market condition, like you see in the green pyramids here, we're going to go back and we're going to look at what percentage of those, okay, turned out to have been favorable. Okay, turns out that 73.8% of those 42 bars ended up being favorable. Now, look at this. We don't know about these last four over here. Okay, we just don't know because they're not labeled anything yet. Enough time hasn't gone by for us to be able to measure whether a bar was favorable or unfavorable on four of these. Over here, this bar ended up being unfavorable because clearly the market blasted off and moved far greater than the implied volatility, what it was saying there at the time. So that turned out to have been an unfavorable bar. So I think you get the picture here. So we have clearly then a situation where we have a positive edge. 73.8% of those bars that match our current condition were favorable. That's greater than the 64.8, giving us a 9% edge. And that's how we do it, folks. We determine our edge doing just that, looking at implied versus the actual volatility in hindsight. Now, let's go, before we get to the other report, just want to make sure you know we have a great curriculum here at Discover Options. We have some mentors that really know what they're doing. They cut their teeth on the floor of the exchange. They've managed money, and they are managing money for people now. And we have folks that have gone through the program and really enhanced their money management practices, increasing by millions of dollars, their amount under management. And we want to help you become similarly an expert options trader in as short of period of time as possible. And we have the tools to help you get there, and we have the people to help you get there as well. So give us a call, check out our website at discoveroptions.com, and we'd love to help you. Okay, here is the the market likelihood report. And the question on the table here is, since Jan of 2000, how often has this same condition occurred? And we know the answer, 45 times, including consecutive ones. And what did the market do in terms of direction and volatility? I mean, if we knew that this condition occurred and most of the time the market went down, I mean, we'd be very interested, wouldn't we? I mean, if it was just, if 100% of the time the market was bearish, I mean, we would want to load up a little bit there. On the other hand, if we could also ascertain that maybe the market went up or became super volatile in either direction. We want to be able to measure that and try and just ascertain if there's any insight from this current pattern, looking at its historical behavior in the past. So what we do is we look at the historical distribution of price as just a benchmark. Then we're going to look at the price distribution after our condition develops. I mean, think about it. You've heard of moving average crossovers. We've heard of pin bars, all these different technical analysis patterns and phenomena and measurements. Well, really, I mean, is there really an advantage to any of this stuff? And if there is, isn't there a good way to measure it and document it? And I don't mean by systems testing using trailing stops and tweaking your trailing stop to just be perfect and take advantage of a given set of data. No, that doesn't count. We want to look at price distribution and just to measure if there is a price bias. That's what we're looking for. And if there is a bias, we want to be able to document that into an edge. All right? So here's how we do price distribution. We're going to measure this. We're going to measure by observing how often price touches one standard deviation volatility bands that are placed from each bar's closing price. All right? And there's three sets. One set above price at the upper 5, 10, and 15 days, and then another set of three on the lower 5, 10, and 15 day levels. We measure these one standard deviation from the close. We use a 20-day historical volatility number, and these are log normally distributed. So here's just an example of 10-day bands. This is a 10-day band up here, set one standard deviation from the close using a 20-day historical volatility. Here's the lower 10-day band. And what we want to do to measure distribution is for this given close, we're going to note if price went up and hit the upper band, or if it hit the lower band within 10 days, or if it didn't and it just wobbled in the middle within 10 days. So let's go and take a 10-day look. And there it is. Clearly, price hit the upper band. And so for that particular close, we record that it hit the upper band. Now, take a look at this close. Got a 10-day band up here, 10-day band down here. Did price hit the upper, the lower, or wobble in the middle? Okay. And you can kind of see it tried to get down. I mean, there's the band, forward 10 days. And it failed to hit that lower band. It clearly did not hit the upper band. So in this case, it hit neither band. And so what we like to do, folks, is we measure historical distribution from every close. We record whether price struck the upper or the lower 5, 10, and 15-day band, and we keep the statistics on how often it did that. For every close, we measure that. And so in this case, through March 31st, starting in Jan of 2000, going through March 31st, there were 4,302 occurrences, closes. The upper 5-day band got struck 29.5% of the time. The upper 10-day band got struck 23.3% of the time. The upper 15, 23.3. The upper 5, the lower 5-day band, 29.4, 29.1. The lower 15 got struck almost 32% of the time. So this is considered our benchmark. Okay, this is the historical distribution of the market going back Jan 2000 through March 31st. That's our benchmark distribution. Now we're going to look at the distribution after our condition develops and compare it to that to see if we have an edge. And we're not only going to look at distribution as of a given close. Okay, here it is, a given close. We're going to look to see if price, what the distribution is if price goes above the previous day's high. We're going to look to see what the distribution is when price goes below the previous day's low. That way, come Monday, you'll have a good idea of the distribution if it goes up above Friday's high or down below Friday's low. There might be a difference between those two distributions, and it might help you give you an edge in your decision making. So here's where we're at. Okay. For all 45 of the occurrences of our market condition, price struck the upper 5-day band almost 12% less often. Only 17.8% of the time did it hit that upper 5-day band. Our benchmark was 29.5. Normally, it would hit the upper 10-day band 23.3% of the time. After our current condition developed in the past, it only hit the upper 10-day band 17.8. It struck the 15-day band on the upside 7.7% less often. Then we go to the lower bands here. Look at this. It struck the lower band 44.4% of the time. That's 15% greater than the benchmark. Look on the 10-day band, 17.6% greater, 10.3% greater. So we see here that the lower bands, out of these 45 incidences, the lower bands are getting struck, look at this, in the 40s, and the upper bands are getting struck not even 20%. Clearly a bearish bias here. Okay, does it mean it's going to go down? Well, no. The upper bands got struck too a little bit of the time, but far more often it struck the lower band. So clearly we have a picture here of a bearish bias. Now, if price goes down, or excuse me, if price goes above the high from Friday, okay, well, it's still striking the lower bands more often, though not quite as much as before. Those lower bands are still getting struck more often than normal. And the upper bands, even if it exceeds Friday's high, the upper bands are getting struck less often, except for this one here. It's about the same for the 10-day, just a squeege above it. Okay, now if price goes below the low, well, then the lower bands are still getting hit, the upper bands are getting hit less often, the lower bands are getting hit more often. Here, look at that, 52% of the time, almost. So clearly a bearish bias that you see here, okay? So that's the methodology. Oh, I almost forgot. We also like to skew adjust this thing so that we will recast those volatility bands to reflect the option pricing where the upside calls are priced lower than the downside puts. So the upside upside volatility bands are closer to the close than the downside bands. Even when we skew it like that to reflect the market expectations, again, a bearish bias with the lower bands getting struck more often consistently across the board here. So definitely a bearish bias, folks, okay? I think we make ourselves clear. Hopefully you understood that methodology, and we hope that it's helpful for you in your decision making this week. I'm Steve Lentz with Discover Options. We are trusted and proven. Please give us a call, take a look at our curriculum. We'll talk to you later. Thanks. Bye-bye.